Hello, this is Paul Drockton with Drockton Bullion and moneyteachers.org, and today we're going to talk about the S&P 500. S&P 500, also known as the Standard & Poor's 500, represents about 70 cents of every dollar that's invested in the American stock market. So 70% of the money in the stock market is invested in one of the 500 companies that make up the S&P 500. So it's probably the best exchange to follow and the best index when you want to get a picture of the overall market. Now, when we look at the S&P 500, we can see that it reached a peak back in 2000, and it was at about 1420. Now, it fell off that peak until it dropped to about 916 in 2002. And then, of course, we saw that it recovered until it hit a new peak of 1481 in 2007. It fell off that peak in 2008, and it dropped to 797, and now we're sitting at about 1300, which is off the peak this year of 1400. So clearly, if you take a look at the S&P 500, 1, 2, 3 times we've seen major corrections. Now, what does that mean? Well, that simply means that if you had invested $1,000 in the S&P 500 in January of 2001, that you would have watched that $1,000 fall down to about $600, and then it would have recovered to about $1,000, and then it would have fallen again down to about $600, and then it would have recovered to about $800, where it would be today. Now, what does that mean? What that means is that if you measure inflation, if you take a look at what the dollar's done over that same time period, over the last 10 years, the dollar's lost about 60% of its value. Which simply means that if you had invested $1,000 in the S&P in 2000, and assuming that you got your money back and you're sitting at $1,000 today, you have lost about 40% of your purchasing power, which means that that $1,000 is now worth about $400. Now, obviously, we're at another peak, and based on the charts that I'm seeing, we're heading into another correction. Now, I'm going to tell you, this correction is going to be as bad or worse than what we saw in 2008 and what we saw in 2002. And we could be looking at a correction as high as 70, 80, 90% of the S&P, which simply means that if you have $1,000 sitting in the S&P 500, it's probable, not possible, but probable, that you will lose 70% of your investment by the time we get to November, December this year. Now, why do I say probable? I say probable because what we're seeing with JP Morgan right now is just a tip of the iceberg. JP Morgan came out and said that they were dealing with a $2 billion loss, which has become a $5 billion loss. And they're not even talking about the hundreds of billions of dollars that they're going to lose from the Greek default. JP Morgan's on the hook for as much as $400 billion just from the collapse of Greece. Italy right now is going through bank problems. We're seeing the same thing in Spain. Portugal, not too far behind. The entire Eurozone, my friends, is in trouble. And to add to this insanity, JP Morgan is one of the banks that has insured all this bad debt, which guarantees that the American taxpayer will be the one paying for it. Now, the bigger issue is this. If JP Morgan collapses, which it looks like it's going to, we're going to end up with probably the end of the current manipulation of the price of silver. Silver right now is bargain basement price, and all I can tell you is that without JP Morgan around to suppress the price of silver, it's going to go through the roof. It has to. And if you compare silver to gold, silver should be priced at about $150 an ounce right now. And that's based on 1 ounce of gold for every 15 ounces of silver. Which means that right now there are 15 ounces of silver available for every 1 ounce of gold. That's the ratio. So the choice really is simple. When we take a look at what silver's done over the last decade, since 2000, silver was trading for $3.90 an ounce, and today it's trading for about $30 an ounce, which is 1,000% return. Gold, of course, was trading at about $2.90 an ounce, and now it's trading at about $1,500 an ounce, about a 600% return. No matter how you look at it, precious metals have outperformed everything else that's out there, my friends, and nothing else even comes close. So, what makes more sense for you, for your retirement, for your savings? To stay with the S&P 500 and watch as the market continues to go down throughout the summer and into the fall? Or to invest in precious metals and know that you're not only going to get a solid return, but that you're going to get significant growth as well. To purchase either gold or silver, simply email me, Paul Drockton, at pdrockton, DROCKTON, at AOL.com. Thank you.